Everybody is talking about inflation, but I've been talking about inflation for over a decade now. Inflation didn't just suddenly creep up out of left field in 2021. Inflation has been the problem the entire time, except that central bankers and governments relied on inflation as the solution to their problem. In fact, for the last decade, the one thing central bankers seemed to agree on, whether it was in Japan or in Europe or here in the United States, they agreed that the problem with inflation was that there wasn't enough of it. We just didn't have enough inflation. Prices were rising too slowly, and that was a problem that the central banks were determined to solve. They were going to do whatever it took to increase the inflation rate up to 2% per year, because 2% was what they claimed was the holy grail of inflation, that inflation must be 2%, prices must go up by 2% every year, and if they don't, well, this is a huge problem, and the central banks need to solve this problem with radical monetary policies. Even if it meant negative interest rates, they would do that in order to make sure that the cost of living went up by 2% per year. Why does the cost of living have to go up by 2% a year? And if it only goes up by 1% a year, why is that a problem? Why does it need to go up faster than that? Most people would rather the cost of living go down. If food got cheaper, people would like that. If their rent went down, everybody would love that. If your landlord said, hey, we've decided to cut your rent this year, nobody would object to that. What if, you go to the gas station and the prices are lower? Good news. What if college tuitions went down? What if medical bills, instead of going up, what if they went down, right? Everybody would love that. Everybody likes it when the things that they want to buy, the things that they need to buy, become more affordable. So why was it a problem for the central banks that the stuff we needed to buy wasn't going up in price fast enough, and it needed to rise faster? And first of all, where did they get this 2% figure? Why is 2% so great? Why not 1.5%? What's wrong with that? Or 2.5%? I mean, why is 2.5% too high and 1.5% too low? Why is 2% just right? And the answer is, it's not. 2% is not better than 1%. It's worse. 1% is better, and negative 1% is better than positive 1% when it comes to prices. But the way this 2% target came about was years ago. Many central banks began implementing 2% inflation as a ceiling. What the central bankers were telling everybody was that we're going to keep inflation below 2%. If it gets up to 2%, we're going to take action, because 2% is our ceiling. We don't want it to get above 2% a year. So as long as it's below 2%, everything is okay. Gets to 2% or higher, we're going to spring into action to make sure it comes back down. Well, somehow along the way, that 2% ceiling became a target where central banks said, we need to get up to 2%. That was never their mandate. No central bank had a mandate of making sure inflation was 2%. It was just making sure inflation was below 2%. That didn't mean that if it was 1%, they had to try to get it up. They would just say, oh, it's 1%, that's great, it's below 2%, we succeeded. But they completely changed. Why did they do that? It was all a pretense. The central bankers were faced with some serious economic problems that they didn't want politicians to have to deal with. Countries had run up a lot of debt, and the governments really didn't have the ability to pay all this debt. And so what central banks did was lower interest rates to make that debt affordable by lowering the interest payments on that debt. And that allowed governments all over Europe, governments in the United States, to continue to pile on debt without having to make any difficult political choices of raising taxes or cutting spending. But also, because central banks kept interest rates so low, it wasn't just government debtors that were able to go deeper into debt. It was the private sector, corporations, individuals. Everybody loaded up with debt. And the more debt everybody took on, the more the Federal Reserve and other central banks felt compelled to keep interest rates artificially low, because allowing interest rates to rise would have caused a financial crisis. A lot of people would have defaulted on their debts, including governments. And so the central banks kept interest rates low and kept printing money. And so right now, they kept saying peak inflation. Every time we had a little downtick in the headline inflation rate, they were like, okay, it's over. Inflation has peaked. And then you'd see another new high in inflation. You know, people think, okay, we're going to get a little bit of a reduction from the numbers we had. That's probably true. I mean, you always get some type of ebb and flow. I mean, nothing goes in a straight line. So maybe the 8.5% year over year inflation will go back down to 7% or 6%. But then the next thing you know, it'll be 10% or 11%. It's not going back down to 2%. And at some point, investors around the world are going to realize that once again, the Fed is wrong and that inflation is never going to go away. Inflation is here forever. And that's when the bottom drops out of the U.S. Treasury market, because right now the yield on a 30-year U.S. Treasury is still well below 4%, even though the inflation rate is double that. And that's at 30 years. Why would somebody want to lend the U.S. government money for 30 years at 3.7% when inflation is already 8%? It's only because they believe it won't stay at 8% for long. They think it's going back down to 2% and it's going to remain there for most of the next 30 years. That's not going to happen. The fact that we had 2% inflation in the last decade, that's the aberration. That's never happening again. We're going to have massive inflation because governments are committed to massive deficit spending. They've taken on so much debt. The United States has a $31 trillion debt right now, and it's already impossible to pay that debt. And it's not like the U.S. debt is financed with 30-year bonds. It's financed with one-year T-bills. All this debt is maturing. You've got debt that the government took on at 25 basis points that it's rolling over at 400 basis points. And so when the world realizes that inflation is here to stay and that it's going to get worse, not only will the bottom drop out of the bond market, but out of the US dollar. This whole dollar rally is based on the Fed winning an inflation fight. And every time we got worse inflation news, the markets just thought, okay, that means the Fed's going to fight harder to win. The markets haven't come to the conclusion yet that higher inflation just means the Fed is losing. And eventually it's going to surrender because it's going to have to turn its attention from the problem of inflation to the even greater problem of a financial crisis and a depression. And when Powell first started talking about the Fed's resolve to fight inflation, it was predicated on the fact that the U.S. economy was so strong that it could take the fight in stride, that we could raise interest rates and not hurt the economy. We had this super strong labor market. Well, we've been in a recession all year in the United States. As much as everybody wants to deny it, we've been in one. It's going to get a lot worse. And once the Federal Reserve accepts and the public realizes how weak the economy is, then inflation is going to take a back seat to trying to solve these other problems. But solving the other problems is going to mean making the inflation problem, which is already bad, worse. You see, when we had the financial crisis and then when we had the COVID crisis, inflation was still officially below 2%. So the Federal Reserve could get away with quantitative easing. They could get away with 0% interest rates because they were able to say we can do this because we don't have enough inflation. But when they try to do it again, when the problem is too much inflation, they no longer have an excuse for creating inflation. And when they try to do that, it's going to blow up because then you're going to have a dollar crisis. Then you're going to have a sovereign debt crisis. And that is a whole new level of financial crisis. And what that also means, what you have to own as an investor are real inflation hedges. Companies that earn money today, not that may earn money in the distant future, because no one's going to pay for some potential distant future earnings in a high interest rate, high inflation environment. Even if the central banks are keeping interest rates artificially low on the short run, long rates are going up and inflation is going up even more. So you have to own real businesses. And because inflation is going to be so pernicious, consumers are going to have to cut back. So you want to own companies that sell goods and services that people have to buy, not what they buy after they buy what they have to buy, because they're not going to have anything left over for that. You got to get out of US dollars. You got to get out of US stocks and bonds. You got to get into precious metals, gold and silver, mining stocks, other natural resource companies. These are the stocks that haven't done very well on a relative basis over the last 10 or 20 years as the Fed was inflating this bubble. They're going to be the ones that do the best as the air comes out of this bubble. We're headed for an inflationary depression, and your portfolio had better be prepared for that.